Welcome back to the channel, everyone. Today I want to talk about how massive liquidations will soon be coming as a result of these new collateral requirements, making major banks easier to liquidate during a crisis, such as the coming crash or the coming squeeze. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Ape-Average tweeted saying big regional banks might face new rules for dealing with a crisis. Bailout prevention proposals could call for firms to raise billions in debt to absorb losses. They are preparing. Basically, these major regulators don't want to issue massive bailouts and force taxpayers to foot the bill. Therefore, these regulators are forcing these hedge funds, these institutions, and these major banks to raise billions in debt and introduce bailout prevention proposals. These institutions won't be receiving taxpayer bailouts. Instead, they'll have to raise billions of dollars in debt from external companies to foot their massive losses. Bloomberg has said that US banks may face new rules for dealing with crises. US banking regulators are considering asking large regional banks to add to financial cushions to make it easier to wind them down in a future crisis. New rules under consideration include requirements for regional banks to raise long-term debt that can help absorb losses in the case of insolvency. So basically, these major banks and these regional banks are going to have to raise way more collateral and hold way more cash on hand, so that when these banks do end up insolvent and they do end up being margin called, at least they still have spare cash to wind down the firm. This extra cash will help these major banks in selling their shares, and they will have additional cash to buy back their short positions, instead of taking on massive losses and not being able to buy back all of their shorts. This basically avoids the DTCC having to come to the rescue and spend billions and billions of dollars, if not trillions of dollars, bailing out these major banks. Instead, these major banks having to raise long-term debt and hold additional cash on hand so they can buy back their shorts and sell off their long positions in the event of a crash. Now, I do think this is very good, as it basically means these major banks are going to have to hold more cash on hand to pay for the squeeze. And it also means these regulators know that a crash is coming and that this crash is just around the corner, and they're begging these banks to raise more collateral so they don't have to pay out as much during the crash. So this therefore basically means as the crash is just around the corner, many of these major banks will soon face massive liquidations. And as Hang Loose tweeted, he said, breaking news. As of today, major banks collectively account for over $1 trillion worth of financial instruments sold and not yet purchased. You may remember that Citadel Securities hold around $65 billion worth of assets sold, not yet purchased. Basically, Citadel Securities has shorted $65 billion worth of stocks, but if you factor in all of these major banks, that figure totals to $1 trillion. And he said, I've added a visualization of just how much money that really is. So if you stack $100 bills to the total of $1 million, it would reach the height of a chair. If you stack $1 billion worth of $100 bills, it'd be taller than the world's tallest building. But if you stack these $100 bills to the total of $1 trillion, it'd be 2.5 times as high as the International Space Station. And he said these firms have inflated their balance sheets by more than $1 trillion by selling shares that do not exist. He said it's ultimately lowered stock prices across the board, of which retail holds, so the 99% doesn't see the gains they rightfully deserve because supply and demand is fake. He said not only is this undermined and diluted the issued shares of thousands of companies, but it's affording these banks the ability to use this surplus counterfeit cash against retail by pushing their now even bigger chip stacks around the market to manipulate prices. And more of our own money is being used against us. When we invest, they're selling us IOUs and using our money to drive these very companies into bankruptcy, so they never have to satisfy these IOUs and they can keep the money. Guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 15 free shares worth up to a whopping total of $30,000, the most free shares that Moomoo has ever given away. And for Moomoo's latest customer agreement, they officially state they do not accept payment for order flow. Therefore, Moomoo does not sell your order flow to market makers like Citadel or to clearing houses like Apex Clearing. Therefore, Moomoo is brilliant for buying those AMC, those GameStop, and those Ape shares. As you can see, the Moomoo platform is also incredibly customizable. It's very easy to use. There's tons of technical indicators and advanced charting tools. If you thought Citadel shorting $65 billion worth of stocks was bad, then major banks shorting a total of $1 trillion worth of stocks is downright horrendous. While I do think the legal shorting of fraudulent companies is important to obviously push the prices of these companies down if they are committing fraud, I don't think the illegal shorting of successful companies should happen at all. The illegal shorting of successful companies drives these companies into bankruptcy and effectively destroys these successful American companies. So we can see that many of these institutions are massively over-leveraged on their short positions. But what happens when their shorts get close to liquidating the fund? Well, I guess the short and easy answer to that is they have to find a way to generate additional liquidity to meet their collateral requirements, or they steal that liquidity from elsewhere. And Freakoin tweeted saying, was the market cap bubble in crypto simply a collateral pump as forced by the short hedge funds to fight rising AMC and meme stock short sale liabilities? And he says this chart says yes, and he asks, I wonder what will happen to meme stock prices when the digital asset prices tank. The screenshot says, was Bitcoin potentially pumped as a collateral hedge against naked short sale liabilities? We can see that every single time meme stocks seem to run up, Bitcoin and the rest of crypto seems to act in its inverse. In summary, meme stocks skyrocket just as Bitcoin falls. I think it's likely because these hedge funds are stealing and grabbing liquidity from the crypto market, causing the prices of crypto to plummet to obviously pay for these short squeeze liabilities. And usually every time Bitcoin ends up being crushed and the prices of crypto fall, the prices of AMC and GameStop rise alongside. Clearly these hedge funds are struggling to generate additional liquidity and additional capital, and therefore they're selling off other assets like crypto assets to take that liquidity back. And this could be getting a whole lot worse with these new collateral requirements and the fact the market crash is just around the corner. As an example of just how close this crash is, Unusual Wells tweeted saying investment banking revenue at JPMorgan Chase is heading for a 45 to 50% decline in the third quarter from a year earlier. Many of these major banks' profits are being cut in half compared to last year as a result of just how close the crash really is. Many of these major companies know that a crash is just around the corner, and therefore they're slowing down or stopping their merger and acquisition activity. This is obviously causing investment banking revenue and profits to plummet at many or all of these major banks. And on top of that, as ShortTheVix tweeted, he said the Atlanta Fed has decreased their Q3 GDP estimates to 0.5% from 1.4%. Now, the Atlanta Fed has already reduced their GDP estimates from 2.3% down to 1.4% before that, and therefore I don't think it'll be long until these GDP estimates are cut negative. That basically means there'll be 3 straight quarters of negative GDP growth, basically confirming the already confirmed recession. One thing I've noticed recently is just how volatile the S&P 500 has been. In the past, we used to have days seeing 0.5% movement or 1% movement on a big day, whereas recently we've seen S&P 500 days down 4% and then up 4% the next day and then down 4% again the next. The S&P 500 is getting more and more volatile, seeing larger and larger movements every single day, which just shows we're edging closer to that massive crash. Volatility is increasing because the trading volume on the S&P 500 has been decreasing significantly over the last 8 or 9 months. This is because many of these institutions are trading less as they're preparing for this crash and they want to have less money invested into the market. But obviously it turns into this self-fulfilling prophecy because there's less trading, there's less volume, and therefore big swings are going to be more volatile and have a larger impact, causing the crash faster. And The Street, which is the mainstream media outlet owned by Jim Cramer, believes the coming crash could be setting up for another AMC squeeze. The article is titled AMC stock is another short squeeze in the works. And it says several indicators point to the possibility of another short squeeze setup in AMC Entertainment stock. It says a rally in the broader stock market could send shares of AMC soaring. And on top of that, borrow fees, the fees short sellers pay to borrow stock to bet against AMC, are close to all-time highs, indicating a lot of interest in shorting AMC. It says shorting costs are generally driven by utilization, availability, liquidity, volatility, and other factors that may determine asset pricing anomalies. And obviously the availability of AMC shares for borrowing is at much lower levels than we saw throughout July and August, especially of last year. And as a result, these borrowing fees have reached nearly 30%, the highest levels this year so far. We also know that short interest is at an all-time high, and it says with short sellers paying higher fees to bet against AMC, they naturally become more vulnerable, especially if pressured by AMC bulls. Therefore, even the street believes and even the street knows that as a result of these higher borrowing costs, as a result of the all-time high and short interest, and as a result of other factors such as utilisation, even the street believes another AMC squeeze is just around the corner. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.